Futures trading involves substantial risk of loss and may not be suitable for all investors.
Good afternoon. This is Oliver Sloup, Blue Line Futures, coming to you from the Chicago Board of Trade. Today is Wednesday, November 19th, and a bit of a red day in the agricultural space with the exception of lean hogs. Before we get into today's charts, let's go over some of today's closing prices. December corn futures down 7 cents, 429 3/4. March futures, which overtook December today in terms of volume, down 8 cents, 441 1/2. January soybean futures 17 1/4 cents lower, 11.35. And over on the wheat side of things, we had March Chicago futures down 9 1/2 cents. Over on the livestock, we had December live cattle 372 lower to 216.30. The now more actively traded February contract down 360 to 217.25. Feeders, January, down $4.60 to 321.45. That was well off of the low, which came in at 316.80. And then, as mentioned, lean hogs, really the strong link in the agricultural space today for the first time in what seems like a lifetime. We had the December contract 95 cents higher. The most actively traded February contract up $1 to 79.02. Now that we got that out of the way, we can go ahead and get into today's charts. We are looking at March corn, as mentioned. That's where the volume is now, and with December options expiration on Friday, that's where the volume is going to continue to flow into. One of the things that we talked about earlier in the week, I think it was Monday or Tuesday in our Daily Grain Express, is options expiration and kind of looking at where a lot of open interest is. There was a ton of open interest on the call side at 440, which in our opinion represented a pretty decent ceiling in the market. And then the max pain point would be where the bulk of the open interest is in the puts and calls, and that comes in near 430. So that's kind of been the gravitational pull in the December futures contracts, which I think maybe helped lead to some weakness in today's trade, but I think could help offer support if we do go a little bit lower from here. And for the March futures, that equates to about 442, 443. So I think this area represents decent value. And as you can see here on the chart, this is also the low end of the range, which was resistance through much of October, the breakout point, and then support since then. It also represents the 50-day moving average. So from a risk-reward standpoint, this isn't a bad shot maybe to look back to the long side. A failure here below that 50-day moving average, and you're looking at a retest of trendline support, which is really only about a nickel lower from here, 435. So the corn market, all in all, you zoom out, you largely see consolidation, right? And we wouldn't be surprised to see that continue. And some people may think that that's a boring trade. We don't mind it, working with clients who like to be a little bit more active. It presents some good opportunities on both sides of the markets when you can get some back and forth going, which is really what we're seeing in soybeans. Now that we got that chart pulled up, January futures, ugly reversal yesterday, marked new highs for the move, and then settled near the low end of the range. And that inevitably bled into weakness overnight and through today's session. And now we're back to that 1135 area, which was resistance at the start of November, and previous resistance is now going to be support. If we break back below 1135, I really wouldn't be surprised to see us back test some trendline support here, as well as the 20-day moving average. So you're talking about potentially another 20 cents of downward risk if we cannot hold this 1135 area going forward. If we do get that pullback to the 20-day or the low end of that range, I would imagine that offers pretty decent support. It'll be interesting to see if China steps in and buys the proverbial dip. That's what they did on the last dip. Who knows if they'll do it again. Regardless, we expect the administration to keep kind of jawboning some optimism in this market. And at the very least, I think that keeps shorts maybe a little bit nervous and maybe tempers their expectations and keeps them from getting overly aggressive. Weather in South America going to continue to be very, very important. We know planting in Brazil is behind pace, and there are some issues in Argentina as well with regards to rains. So something to keep a very close eye on going forward. Probably keep the volatility alive, and a lot of people kind of arguing back and forth on a number of different topics. I welcome that. That's what makes a market when you have two people going at it on each side. That's what makes things fun, and we really hadn't had that all year long. So this is a breath of fresh air to see arguing. You can't say that too often. Now moving over to the March contract in the wheat futures, kind of coiling up, leading to somewhat of an inflection point probably here in the near future. We tested and rejected trendline resistance the last two sessions. That has brought us back to the 20 and 100-day moving average. Below that, you're looking at some trendline support near 544, so about another nickel lower. I wouldn't be surprised to see that hold. We do have the 20-day, which is crossing or potentially about to cross above the 100-day, which is often referred to as a golden cross. So some bullish price action despite the bearish fundamental headwinds that this market has. The U.S. dollar breaking out, that's also a headwind. So that's something to be a little bit cautious of here in the near term. But all in all, I think these grain markets can continue to stair step higher. At the very least, present some good opportunities, again, with the back and forth trading that we've seen over the last week or so. Hopefully that continues and people can try to pick up a little bit here and there and go. Now, over on the livestock side of things, we've got diesel live cattle broke to new lows for the move today, below that 200-day moving average. Below that, you're looking at the 50% retracement, which is just a fancy way of saying the middle of the trading range for this year. Again, that's near 210. Fundamentally, I'd like to believe that there's pretty good value here, but a lot of times in these environments, you overshoot fair value, not only to the upside, but unfortunately to the downside as well. So if we fail to really hold today's lows, I really wouldn't be surprised to see additional long liquidation ensue and pressure this market maybe further than it really should. Again, that's not uncommon in the futures market where you see things accelerate and exceed fair value. But we'll see how the rest of the week goes. Again, fundamentally, I think this market has support technically, continues to be very, very weak with lower highs and lower lows being the clear trend over the last month or so. And moving over to the feeder cattle market, you see the same type of setup, although the January feeder cattle have already found their 50% retracement and have been just kind of treading water against that over the last couple of weeks. We still have lower highs, which is a concern. We've got the 20-day moving average coming down as resistance as well. That comes in near 329. If we can get out above there, maybe we get back to 330, 335. But getting out above there with some sort of conviction might be a little bit of a tall order here in the near term. And then we'll hop over to lean hogs here to wrap it up. We've got the April contract pulled up. A nice recovery today, although the chart still looks ugly as sin. We are still hopeful. It is the wheat of the livestock markets is what we've been referring to it as. If we can get back out above this 50% retracement, 84.97, I wouldn't be surprised to see that neutralize some of the bearishness that we've seen over the last week or so and maybe start helping this market try to carve out somewhat of at least a near-term low. So those are the things we are looking at in the agricultural space. Over on the precious metals real quick, silver. Got the December contract pulled up. I think late last week we talked about the potential double top here. That's still in place. It looked like we were going to go retest that again in the overnight session, but that was sold into. Right now we still have a positive candle on the weekly chart. If that turns into a negative candle on the weekly chart, I think that could potentially look quite bearish. Potential retest of that 46 area, 47. There's also the 50-day moving average that comes in down there as well. So regardless, silver and gold going to be very, very interesting here in the coming weeks as it's kind of go time for these metals. It's either make or break. So if you've got any questions over that, our chief market strategist, Philip Strebel, he covers the metals extensively. He can give you some game plans on how to attack that market. And as always, we've got a trade desk here that's ready, willing, and able to help as well. So don't hesitate to reach out. Remember, trading futures and options involves substantial risk of loss and is not suitable for all investors.